Hello, I'm Matt Schwartz with Schwartz Insurance Group in Louisville, Kentucky, here with another in our video education series focused on employee benefits. The purpose of our series is to teach you about the basics of reform and other benefit concepts, to share the latest ideas and tactics that employers are using to be successful, and in short, to position you to be a pro with regard to your benefits, communication, and culture. I want to talk today about the large group market, and so generally that would be defined as, under the law, really over 100. Some states it's still as 50 plus, but basically I want to talk about the taxes and fees that are would be top of mind with regard to those size employers. So first, I'll start with the idea that of course there is the employer mandate that it applies, and of course the Supreme Court had ruled that legal, and that the fact that it was a tax. So in essence, it basically says that if a large group employer, depending on the rules have changed now. It delayed from 2014 to 2015 for groups over 100 full-time equivalents, and to 2016, January 2016, for groups with 51 or more full-time equivalents. So if you don't provide minimum value and affordable coverage, there are penalties that apply, either a $2,000 penalty if you don't provide any coverage at all, or the potential of a $3,000 penalty for those if you provide coverage that's not minimum value and or not affordable, and that would apply to those employees that go through the exchange and they purchase coverage and they get a tax subsidy. But when you then talk about the fees that we know are really going to apply to every plan, those probably won't impact that many employers, but the ones that we know will, there's the first called the PCORI fee, Patient-Centered Outcome Research Institute, and this is really a comparative effectiveness fee, as the government described it. Not a large fee. It started off the first year, it was $1 per member per year, and so that means not just an employee, but any family member that's covered by the plan. And then it shifted to $2, and that lasts through 2019. And so not a big fee. So if you're talking about 100 employees, typically you may end up with 200 total family members. So that'd be 200 times $2, which is $400 for the year. And so that's going to be filed actually by the health plan if you're fully insured, and if you're self-funded, the plan would be responsible for filing that fee. It's based on a calendar year. Actually, I'm sorry, it's based on a plan year, and it's actually every year at July 31st is when that fee is due. The second is called a Transitional Reinsurance Fund, the TRF, and that's actually to help support the individual market. It only lasts 3 years. Essentially, the first year it was in 2014, it was a $63 per member per year. Again, not per employee, but per member. And then it drops actually to $44 starting in 2015, and it'll probably drop again. But if you think about that, so if you have 100 employees with 200 total members covered, that could be somewhere around $13,000 a year. So those both are definitely going to apply to any employer, whether they're fully insured or self-funded. When you get to the third, which is actually the largest of the fees that apply to premium, is something called the insurer tax. So as the name implies, it only applies if you're fully insured. So you have an insurer that's going to actually pay these fees. That turns out to be, in the first year, 2014, it was in the range of about 2.5% to 3% of premium. It depended on the volume of business in a certain state and the volume of that particular carrier. So it is expected to rise over a few years. So in essence, I mean, it's going to move from an $8 billion total expense up to about a $14 billion over a few years. So that definitely will rise from 2.5% to 3%. The other things that you think about with regard to taxes and fees are just things that you typically communicate to employees. So things like the individual mandate, where there is, again, a tax applies if somebody does not have insurance. Things like the limit on flexible spending account dollars, up to $2,500 a year. Things like over-the-counter medications that are no longer deductible. So there's some things that you communicate with employees, but nothing that's a direct impact to the employer. So with regard to today's topic, if there's additional information that we can share with you, please touch base. If you have any specific concerns or issues that we might be able to help you with, please let us know. We'd welcome your feedback, and we'd love to hear from you about a future topic if you have an idea. So again, I'm Matt Schwartz with Schwartz Insurance Group here in Louisville, Kentucky. Look for the next in our series so that you too can be a pro with regard to your benefits, communication, and culture. Thank you.